Have you ever wondered why price moves the way it does? Why do sudden spikes happen? Why does the market reverse at specific levels? Well, the answer lies in order imbalance. This is one of the most powerful yet overlooked trading strategies used by institutional traders. And in this video, we are breaking it down so you can start using it to refine your entries and exits with precision. Stick around to the end because I'll be showing you a step-by-step method to apply this strategy in your own trading. Okay. Now, what is order imbalance? The market moves because of one simple reason: an imbalance between buy orders and sell orders. When there are more aggressive buyers than sellers, price shoots up. When sellers overwhelm buyers, price drops. Okay, so this imbalance is caused by institutional traders executing large orders that create inefficiencies in price. Retail traders don't typically see this, but if you know how to spot these imbalances, you can take advantage of them before the market corrects itself. Okay, so how do you recognize an order imbalance in the market? There are a few key signs. Okay, when you see strong impulsive moves, when price moves rapidly in one direction with very little pullback, it signals an imbalance in orders. All right. Okay, let's see if we can find a very good example. Okay, you can see what happened here. Right, you can see what happened here when price moves rapidly in one direction, and this is literally the daily chart, the daily time frame. So you can imagine, with very little pullbacks. In fact, this like was the only pullback, and it was just, in fact, I don't know, an insignificant pullback that occurred here over how many days, right? So it signals an imbalance in orders, right? And then you will notice large candlesticks. You can see that we had large candlesticks here. A big bodied candle with almost no wicks suggests heavy buying or selling pressure, indicating an institutional move. Okay, and then sometimes you might notice gaps in price. Okay, there was a gap that occurred somewhere around here. Can you see? Let me just mark out this point. All right, can we see that we had a gap here, right? So gaps in price usually occurs when price jumps from one level to another. Price jumps from one level to another without filling in. It usually means that liquidity was swept up too quickly, leaving an imbalance. Now, a great way to spot these imbalances is by using order flow tools, footprint charts, or simply analyzing price action on higher time frames to see where these zones have formed. Okay, now let's just break down how you can trade order imbalances effectively. The first step is identify the imbalance zone. Look for strong moves in price with little or no pullback. These areas create what we call an imbalance zone, where price has moved too aggressively, leaving unfilled orders behind. Then you wait for retracement. Okay, the market tends to retest these imbalance zones before continuing the move, right? Let's just go back to that first example. You can see. So the market tends to retest these imbalance zones. You can see that there was a significant pullback, Okay, when price pulls back into the imbalance area, this is your signal to prepare for an entry. All right. Then the third step is to confirm with confluence. Do not take trades blindly. Okay, combine your order imbalance with other factors like support and resistance levels. Okay, and then look for liquidity zones, look for volume spikes, and smart money concepts. Okay, so when multiple confirmations align, you increase the probability of a successful trade. Then the next step is to enter the trade. Okay, once price enters the imbalance zone and shows signs of rejection, such as a strong bullish or bearish candle, then you can enter your trade. All right, then set your stop loss just below or above the imbalance zone to protect against fake outs. Then for your take profit, you can target the next key structure level, which is going to be the next resistance or liquidity zone. Okay, that's going to be for your take profit. All right, ensure that you always observe good risk management. All right, do not trade with an amount that you cannot afford to lose, and do not risk more than 2% of your account balance in a single trade. All right, now some final tips before we round up. Be patient. Okay, because imbalances don't happen every minute. Okay, you might not find imbalances all the time. All right, you might not find such scenarios all the time. So but when they do, they provide high probability trade setups. And next, always trade with risk management in mind. Okay, do not over leverage your position. Okay, on no account should you over leverage your positions. Do not use outrageous lot sizes. All right, try to protect your account, protect your capital. Okay, capital preservation is very, very important. And then combine this with other trading strategies like supply and demand to make your trades even stronger. All right, now if you found this strategy valuable, hit that like button and subscribe for more trading insights. Okay, let me know in the comments, have you used order imbalance in your trading before? If you have, what was your experience with it like? Okay, let us talk in the comments section, and do not forget to turn on notifications so you never miss a video. All right, in the meantime, thank you for watching, and I hope to see you in the next video. Happy trading.